I'm Neil, and I'm the teacher.
And I'm Sean, and I'm the deal maker.
Together, we're the Rise Guys.
Welcome, I am Neil. When the real estate market is on fire, there is one major pothole that can completely wreck a deal. The appraisal gap. We are going to break down exactly what happens when your buyer's winning offer comes in higher than what the bank thinks the house is actually worth, and more importantly, what you as their agent need to do about it. You have to remember a mortgage is a huge investment for the bank, and that entire investment is secured by one thing, the house. So the bank's number one job before they hand over a dime is to make absolutely sure the collateral is worth the money they're about to lend. They order a bank appraisal. This has nothing to do with the listing price or your buyer's emotional got to have it offer. It is a cold, hard, independent valuation. And a really important term here is the loan to value ratio, or LTV. At 80% LTV, the bank will finance up to 80% of the appraised value. Notice it did not say the purchase price. This is the moment of crisis. Your buyer offered $525,000 to win the war. But the appraiser looking at hard data and recent sales says the house is only worth $500,000. That $25,000 difference is the appraisal gap. The bank bases its loan only on the appraised value. At 80% LTV, the max loan is still just $400,000. But your buyer is legally locked in. You have to pay $525,000. So the buyer's down payment just exploded by an extra $25,000 in cash they have to come up with before closing. This is probably the single most dangerous misunderstanding in this entire situation. The financing condition protects your buyer only if the bank says, no, we will not give you a loan, period. It does not protect them if the bank says, yes, you are approved, but it is going to cost you more, or you need to bring way more cash. In our example, the bank approved the financing. The fact that it requires an extra $25,000 in cash from your buyer, well, that is not the bank's problem. The condition has been met and your buyer is stuck. This is not just friendly advice. This is a core standard of practice. RECA is crystal clear. Your job is to give clients the information they need to make an informed decision. Providing competent service is all about foresight. First, you have to talk about appraisal risk before you even start writing an offer. Second, clearly explain the limits of that financing condition and tell them flat out it will not save them from a cash shortfall. Third, bring up the ugly possibility of expensive secondary lending to cover a gap. And finally, look them in the eye and ask the tough question. If this appraisal comes in low, do you actually have extra cash to cover that difference? At the end of the day, preparing your buyer for an appraisal gap is not about scaring them out of a deal. It is about protecting them. It is what builds real trust and makes sure they go into a bidding war with their eyes wide open. So the real question here is for you. How are you going to change your conversation to make sure your next buyer is truly ready for the realities of a hot market before you go? New webinar summary every week. Subscribe so you never miss one.